All right, should be back here with you. So right now we're going to have Buddy Hartmann from Hartmann Company. He's been, well, I'm sure he's going to tell you a little bit about himself, but he runs a CPA firm in Connecticut, I believe. He's been working as a, very closely with day traders and the day trading community for over 12 years. I met him, I think, at a recent show, one of the trade shows, and we've been in contact a few times, and this is the first time we'll be making an appearance on the show. But he does. He's going to be a close, friend of the show, so he'll be making visits every so often to answer your tax questions. You might even see him in the room sometimes. So definitely use the opportunity to ask him any questions that you need. So let me just hook him up right now. Let's get him on the line. And see how this works out here.
Buddy Hartmann.
Hey, buddy, it's John.
Hey, John, how are you?
Good. How you doing?
I'm doing fantastic.
I'll just introducing myself to the audience here, but good that I'm glad that you could get on the radio here and talk some taxes with us today.
I'm glad to be here. Thank you for having me, man.
You've been in the tax business for a while.
Since about 1997, I've been working with traders, so it's been a fun ride. It's one of my big passions. I love the market, and it's a great niche for taxation.
All right, excellent. You started. I've met you. I think the first time was down at one of the trade shows. So yeah,
the New York City Trader Expo last year. Yeah.
Yes, Trader Expo. So, so we got in touch with you, and things have come to this point where actually I talked to you on the phone the other day, and you had some great things we were going to talk about. Let's start off. Your website's Hartmann. Let's go over that again. What was that?
HartmannCompany.com.
Hartmann Company with two
all
N's.
one word. So 2 N's and Hartmann. www.HartmannCompany.com.
All right. We got a lot of I kind of threw this out to the audience, so we got a lot of questions. But I know we had a kind of like a little format for today. We were going to talk about some important questions that every trader has. Everyone has these same questions, like what is trader status, what is mark-to-market accounting, what's the wash rule, entities, should you be incorporated? I mean, these you must get this question. Are these the most?
Those are 5 basic questions that come up continually when you talk to a trader. And the way that I always do it is, first and foremost, trader status is always step number 1. When I do seminars, when I teach about trader taxation, I like to do it in steps. And step 1 is clearly always going to be trader status. The IRS, they're not very good at giving our traders any kind of guidance. It's not codified. And what that means is it's not an IRS code. There's nothing in there that'll say, hey, John, read this. If it applies to you, you are a trader. A lot of it is handed down through the courts over the years, and they come up with specific tests. And, one of them is a 2-pronged test where the trader's activity must be substantial. And then the trader seeks to profit from short-term swings in the market rather than long-term appreciation of holdings. But if you look at this, right, I mean, on the front of it, it looks okay, but substantial in these court cases mean a lot of different things. And the trading, does it mean trades? Does it mean gross proceeds? Does it mean the amount of time you put in?
Yeah.
All of these come to trader tax status.
Is this defined anywhere?
What we do have from the IRS is it's publication 529, Chapter 4, and I believe is a page and a half for our traders. And that's what the IRS really gives us. Other than that, it's basically looking at court cases. They provide general characteristics, but they do not give you a hard and fast rule of if you do 500 round trips a year, if you're doing it full time, if this is your only employment, then you're a trader. They don't provide that. So it is a gray area.
Yeah. So, but you get this a lot. And how do you? What's the first thing a trader does? How do you know if you fall into the category? And is it a benefit to have that? I mean, what's the big difference between trader status and? I'm going to be asking you basic questions. A lot of traders ask me.
Yeah.
What's the big difference, and why is it so important to have trader status?
Okay. Well, to me, first thing and foremost, trader status is there's a huge differentiation between being an investor and having trader status. You're severely limited on the investor side. So let's assume that we've got a trader, we got two people. One qualifies for trader status, and we'll go over that in a minute. The other one's an investor. On the trader status side, once you achieve trader status, once you apply all those characteristics and they apply to you, that treats you like any other ordinary business. So that opens up all your ordinary and necessary business expenses that you can deduct. Your margin interest is now deductible. Okay? Mm-hmm. Your home office, all your trading data feeds, all your related items, supplies, auto in some cases, travel, your seminars, going to the Trader Expo convention, all of these become write-offs.
Write-offs.
Your chat room for DayTradingRadio.com, fully deductible. Take a quick look on the other side. I know I'm going through this quick, but we don't have a lot of time.
Yeah.
If you look at it on the other side from an investor, investors are really only allowed to write off mainly, data feeds, investment-related information. So if they're taking a seminar and they pay a lot of money to go to one of these schools to take a seminar as an investor, your class time's not deductible. You can write off the books because they're providing information, but that actual class time, it's non-deductible. The other thing is, when it comes to traders, a lot of your expenses are not limited. As an investor, we're going to put those expenses on a Schedule A. They're going to be unreimbursed employees, not unreimbursed. They're going to be down in the itemization of 2% of your AGI. So there's a limitation right there. If I have a trader and a wife, and they're making, say, $100,000 a year, that 2% means the first $2,000 of their trading expenses are non-deductible. Anything over and above it will be deductible.
Wow.
Then the next step would be, especially for us in the Northeast, New York, tri-state area with high tax, state taxes. If you run into the alternative minimum tax, which can easily happen for families, 150 and over, all of those expenses, your investment expenses, are a complete add back, and you'll get zero for it.
Wow. I mean, it seems way complicated.
Don't get me wrong, trader taxation is very complicated, but again, the step number one is trader taxation. If you can pinpoint it, make sure that you meet those characteristics.
Let me ask you one question on it. What's the biggest requirement for day traders? Is it the amount of trades you do, or is it your overall?
To me, it would be. In the end, it will, I believe, always come down to your trades. Everything else is building the case for trader status. But if you're very light on your trades, then I think you'll have a hard time. For a mature trader, I'm looking for 3 to 5 round trips on average per day, if not more. Okay, and I say on average because you don't always have your entries or your exits in a particular day, and one day may be much better than the other.
Yeah.
So it really comes down to trades. If you're a beginning trader, I think you can slip under those numbers, but not for a very long time. 1 round trip in the beginning, getting up to 2 round trips, 3 round trips. I mean, you really should be somewhere around 3 to 5. I like to see it 5 and plus. 5 and plus, full-time, consistent trading, and especially if it's the only thing you're doing, I think that you don't have a problem.
Now, is this something that gets flagged that very easily? Like you try to put in that, you apply for the trader status, and the next thing you know, they're calling you out on it. And I mean, does this happen, or is it something that people just can apply for, or do you have to send the records in?
This is a great question, because a lot of people have the misconception. Trader status is clearly not an election. It's not something we send to the IRS. If you meet characteristics of being a trader and we think that you qualify as a trader, all it is an application. So we would apply it to your return.
Nice.
So if I have an individual trader, he's got a retail account, Charles Schwab, TradeStation, whoever it may be, and he's trading, he's doing enough trades, he thinks that he qualifies or she qualifies as a trader, it's as simple as then your expenses are opened up, put you on a Schedule C, and you're able to write it off.
Wow. And there's a lot of stuff you can write off.
There's tons. I mean, you have to really think about yourself as a business. Once you achieve trader status, I'm a business. So that means everything can be written off, as long as it's got a business purpose.
So then would the next logical, the next logical thing is, do you need to set yourself up as a business?
Well, when you say business, you mean entity.
An entity.
Correct?
Yes.
I mean, to be honest with you, this is one of the questions. I've got beginner traders who'll call me up, and right away they're like, I need an entity in order to be a trader. And the answer to that is no. We just talked about it. You achieve trader status, your default is a Schedule C. Okay?
Mm-hmm.
The one reason, or there's a number of reasons why we would then step up to an entity. Okay? And the main reason is this. If I'm a trader and I make $100,000, John, you're a consultant, you make $100,000, right? Our trading is short-term. It's taxed at our highest ordinary rate. You're consulting, taxed at your highest ordinary rate. The only difference there is that, John, you're getting hit with 15.3% for self-employment tax. Thanks to Congress, our traders, Forex, equities, options, anything, they're not subject to 15.3 at all. That's a savings on $100,000 of $15,000.
Wow.
So, because of that, our traders then can't deduct their health insurance, and they also can't do any retirement planning. So those are the two main reasons that I would put you into an entity. The reason that we would put a trader into an entity is because then they can pay themselves. And when you pay yourself, you're creating the earned income to then get the additional benefits.
Yes.
Remember, we can already write off most of our trading expenses just by achieving trader status on a Schedule C. We can get more complicated and more complicated, but I think for our time today, to really step up to an entity, there's got to be a few things. Schedule Cs, it doesn't matter if it's a trader or not, they're always going to be under more scrutiny than an S-Corp, than an LLC. So that's another reason we might put a trader with low trades into an entity. Pulls them out of a large audit pool in Schedule Cs into, say in New York. You go into an S-Corp or an LLC in New York, you're going to be a small fish in a very big pond.
Yep.
So that's one other addition. And then the other for the entities is not just the trader, but now I can get involved partners, a wife or a husband, as long as they have some kind of duty inside the LLC, then they can also get those added benefits. We can write off their medical. We can do retirement planning for them.
Wow. Well, you really seem to have everything. You know everything from the experiences that you've been doing.
I try.
Yeah, I mean, this is
there's
probably
a lot there. There's definitely a lot there, and there's a lot you can do, and there's a lot you can be much more complicated with your tax planning also. But my philosophy, and I told you this from day one, is in the beginning, keep things simple.
Keep it simple.
Yeah,
we got a lot of
multi-entity scheme. When you have like a C corp and an LLC, they talk about how you can get all these deductions and you can do so much with tax planning. Mm-hmm. But if you're a beginning trader, a lot of times beginning traders have losses. If they're having losses in the beginning or they're not making a lot of money, these schemes really don't work in the beginning. That's why I don't get too complicated unless I know it's an intermediate trader or clearly it's a trader that I know is going to be consistently profitable.
Okay. Buddy, we have tons. I don't know if you're in the chat room or not, but you got tons of questions rolling through. I know we're not going to have time to answer all these, but there are a couple of them keep on coming up, and I know we're going to touch on a couple of them. Someone's asking about mark-to-market accounting. Please review the mark-to-market election, particularly for sole proprietorships.
All right. Mark-to-market, when we talk about mark-to-market, it's an absolute must for our equity and option traders unless. There's really only one reason why we wouldn't do it. If you have capital losses that you're carrying over and they're large, and you have no other means, like an investment account, investment property, to offset those, then you probably don't want to elect mark-to-market. And the reason is, when you elect mark-to-market, your equities trading is no longer capital gain and loss. It becomes ordinary income. And that's the beauty of mark-to-market. So if I had large capital losses in 2011, I elect mark-to-market for 2012, and I had a gain in 2012, that gain now is ordinary due to mark-to-market. So that means I can't offset it against those previous losses.
Yeah.
This is the only reason that you wouldn't elect mark-to-market.
Yes.
Okay? But looking at mark-to-market for our individuals and our entities, this is a great thing to have. On the gain side, if I make $100,000, it's taxed just like my short-term capital gain and loss. Short-term capital gain, highest ordinary rate. There's no change there. The beauty of mark-to-market is tax loss insurance. If you have a loss, you're not limited on them. Remember, capital loss, you're subject to $3,000 unless you have capital gains. When it comes to mark-to-market, it's ordinary business loss. It doesn't matter if it's $10,000, $100,000, or $1 million of a loss. That is freed up. It goes on page 1. It can offset W-2s, interest, dividends, IRA distributions. It can offset everything on page 1 if you have this loss.
Wow.
And, not to sound cheesy, but it's like car insurance. You drive around in your car, you have insurance, you hope you never get into an accident, but when you do, you're glad you have it.
Yeah.
That's all mark-to-market does. It does nothing on the gain side. I've got traders that elect mark-to-market, have had gains all along. It doesn't do anything for them. It's for that rainy day when you have a bad year.
Right. Well, that's a good explanation of that. Oh, low tick alert. I got lots of questions here. I'm going to actually forward some of them to you. Let's just go.
Do you want me to talk quickly about the actual election for mark-to-market for individual traders? Because that's coming up. That's a good question.
Yes, absolutely. When do you have to? Yeah. When do you have to elect that?
All right. So now, for any individual right now, I know it's the end of 2011. As an individual trader doing a Schedule C with trader status, we've already missed it for 2011. We can't go back and change that. So all we can do is perspective going forward. So it's got to be done for individual traders by April 15th. It's got to go in with your 2011 tax return or your 2011 extension. So there's 3 parts of it. You're going to do the election and send it in by April 15th. At the end of the year, you're going to apply mark-to-market to your trading gain and loss. And then when you file your 2012 return, you're going to do a Form 3115, which is the method, the change in accounting method. Those 3, if you miss any one of those, you're going to be in trouble. The first one is imperative. If you don't do it by April 15th, you're in trouble. You're going to miss it as an individual. Okay?
Okay.
And then if you don't do the Form 3115, they do have the ability to say that you didn't complete the election, your mark-to-market's gone. Now, for entities, if you set up an entity, IRS considers, if it's a new entity, they consider you a new taxpayer. That means you have 75 days from inception to elect your internal accounting method. Mark-to-market's one of them.
Okay.
So you can do that election internally in an entity and not have to send anything to the IRS. Okay?
Gotcha. Yep.
Do we have any? Should we talk about futures at all or no?
Yeah,
Future
absolutely. Yeah. We have a lot of futures traders, and someone actually asked that question in regard to futures. How does this play?
Good. Typically, for futures traders, I only do mark-to-market in certain planning situations. Typically, if you did mark-to-market for a future trader, it gets rid of their capital gain treatment, and there's a preferential treatment there. It's a 60-40 split, 60 long-term, 40 short-term. If you elected mark-to-market for your futures traders, that is gone. It becomes ordinary income. So if we have a future trader that elects mark-to-market, they make $100,000, they're paying at their highest ordinary rate. They're not getting a preferential blended rate. Okay?
Yep.
But if they elect mark-to-market, of course, they do have that ability to use a loss.
Yeah.
Okay?
All right.
So I usually stay away for futures traders. Stay away from the mark-to-market because we want to keep that blended rate. And the only, the main only reason that I would do it is if I had a trader come to me at April 15th and they just had a really bad year in futures already and they lost a lot of money, we would probably elect mark-to-market at that point, tax planning, maybe set an entity up, set up the futures accounting entity, and then they could bypass the mark-to-market because it's a new entity and it can pick its own accounting method. So there's a way around it.
Gotcha.
Okay.
Yeah. We had a little issue with the phone there for a second, but again, this is being recorded, so we're gonna hopefully, if you guys need to revisit some of the information, plus Buddy will be,
I don't know if it's my side. Is that better?
Hard to tell. It's not bad. It's not bad. Someone in the room just mentioned, just made a comment. He says, "I understand once you make the market-to-market election, you can't revert back to a wash rule. If true, wouldn't it be best to have your trading LLC elected as mark-to-market and keep your individual status as wash rule?"
Well, one, I don't like wash rules for anyone. I mean, if you understand what a wash rule is, it really was put in place for year end. You know what? I'm going to have to get on. My headset's going. Give me 1 second.
Sure thing.
Of course. That might have been the problem. Is that better?
Oh, yeah.
All right. And then it's got to be my headset. It was a low battery. I apologize. All right. So back to the wash sale. When you talk about the wash sale, the reason the IRS put it in place was basically for a year-end scenario. And that is, I'm holding, let's say, 100 shares of Cisco. During the year, I paid $10,000 for it. At the end of the year, the fair market value is $5,000. I think I'm going to be a smart guy. I sell it at the end of the year, so I'm harvesting that loss.
Mm-hmm.
And then January 3rd rolls around, I buy that same 100 shares, $5,000. What did I do? I'm basically in the same situation, but I was able to harvest that loss. IRS says, absolutely not. This allows a loss, carries it back over. Now on January 3rd, when you buy it back, your basis is now $10,000 again. You're in the same position you were before then. So it's a 30-day window for wash sales. If you're a trader, you're not mark-to-market, come Turkey Day every year, you got to start thinking about your wash sales. Got a lot of traders that trade the same stocks over and over again. Apple, IBM, whatever it may be. They're trading it over and over again. They got to be aware of the wash sale rules.
Yeah, good point.
And mark-to-market gets rid of them.
Yep.
You elect mark-to-market, you don't have to deal with wash sales at all.
Here's a question coming in from Farley. If I sell a security for a loss and buy that same security back within 30 days, because I wanted to touch on this. These are a couple questions. I lost that loss amount due to the wash sale. What change in my brokerage account do I need to do so that I don't incur such a wash sales?
Well, that's exactly what we were just saying. I call it like a Turkey Day rule.
All right.
So when Thanksgiving rolls around, that you're a little more than 30 days from year end. You really should be you should be looking at your trades. As a trader, you should be looking at your trades constantly anyway, finding out what works, what doesn't work. But clearly, when it comes to Turkey Day and you're not mark-to-market, you have to worry about wash sale losses. That's when you're going to start looking at it and you're going to say, all right, again, a lot of you guys out there should have a good software that you can analyze trades and you can pinpoint certain stocks and analyze those. That way...
Yeah, go ahead. Sorry.
That way you'd be able to kind of look at it and say, all right, I've been heavy on Apple for the last couple of months. Things haven't gone well. I have some losses. If I keep trading it, I may run into the wash sales.
Yeah.
And the wash sales trail throughout the whole year. Once you stop once you stop trading something for 30 days, they're gone.
Okay. Well, you mentioned the software for it. Let's just touch base on that for a second. If someone would come to you and do you recommend them tracking their trades using a certain software? Because I know I have to deal with this every year too, and I think I forget what I use, but
TradeLog?
One of the trader ones, TradeLog.
Yeah. I mean, my favorite of all, I've got clients that use all different ones, but Armin's done a great job with the TradeLog. I think it's fantastic.
So TradeLog.
I think, TradeLog, you can get it at certain levels. You can get it for mark to market. So it depends on the type of trader you are. They've got an unlimited version. So, I mean, to me, the support there is fantastic. I think they do a great job.
All right.
And for some brokerage houses, they don't do a bad job of reporting either.
No.
So, instead of going out and spending the money for it, you may be able to utilize the broker services. You are paying them in commissions.
Mm-hmm.
But if you want to, like I said, if you want to kind of dissect your trading, TradeLog's great for that. You can pick it up by ticker, time periods. You can chart things, winners, losers. I mean, very, very good software. He's had many years where he does great upgrades.
Here's an interesting question. I'm following you guys from Malaysia and not residing in the U.S. I would be wondering if gains and profits from stock trading for me from back here, Malaysia, is subject to any kind of taxation from the U.S.
Typically, it should not. As an individual trading here, typically it will not. This is a tough question because it depends. If you're a prop trader and you're involved with a U.S. firm, or if you set up a company in order to get into one of the brokerage houses here, there could be complications. There could be taxation. But typically, you're not going to be taxed. You have to have a presence in the U.S. There has to be some kind of presence here in the U.S. for you to be taxed. So if you're just sitting in Malaysia and you're trading, more than likely, you're not going to. But that was, I got an email from one of your traders up in Canada, and basically I do U.S. When it comes to traders, I do U.S. taxation. So I don't do a lot of Canada. I don't do overseas. I have a lot of high net worth clients that are overseas that we work with, employees. Again, familiar with foreign taxes, but for traders, basically it's going to be U.S.
Can trade losses be subtracted from investment dividend gains?
Can investment losses?
Can trade losses be subtracted from investment dividend gains? Just a question.
Good question. Are you mark to market or are you not mark to market?
Good question.
All right, so let me answer both. If you are not mark to market, that means you have capital loss. So that means if there's no capital gain, 3,000 of that would go to page one, and that could offset against dividends. So yes, but you're limited. Okay?
Yep.
If you're mark to market, like I said before, the great thing about mark to market is if I lost $10,000, would go on page one. If I made $10,000 on dividends, net, I'm not paying anything.
Yeah. Question here coming from the chat room. I use Fidelity and always says something is a wash sale, even if I have not touched it again in 90 days. Can you explain why?
Can you repeat that? I'm sorry.
I use Fidelity. This person coming in. It always says something is a wash sale, even if I have not touched it again in 90 days.
First of all, Fidelity does a great job doing the wash sales. If you're mark to market, you can ask them to run the gain or loss for you without wash sales. I can guarantee, well, I shouldn't say guarantee anything because brokerage houses get things wrong all the time. I would assume, without looking at it, that they're showing it as a wash sale, but it would not be a wash sale. If it's over 30 days and it's sold and you didn't buy it back within 30 days, there is no wash sale.
Okay.
Okay. And remember, the funny thing about this wash sale rule is that it goes for all accounts. It's not just your trading account. It's not just your investment account. It could be your IRA account. So it goes across all the boards. and is very complicated, and I don't know why the IRS has to make it so complicated for us. It shouldn't be.
Gotcha. Question right here. There's a lot of good questions here. We kind of touched on this one, RK Trader. Could you please ask your guest about what kind of expenses an independent trader can claim, and how to push that to get the maximum deductions?
Well, again, when we say push, we want to make sure that these, one, you qualify as a trader, right?
Yep.
And then two, clearly that these are business expenses and can be validated, if we were ever looked at from the IRS side. When I look at doing a return, the main thing I do is we look at expenses. If we were being audited right now, would this go through? Absolutely. We don't have any problems. Gray area, we need to make a decision on it. But again, it depends on what type of trader you are. But in general, I mean, data feeds, seminars, chat rooms, anything related, investment, Bloomberg. If you're at home, you've got your home office, you got your cable, you got your DSL, a portion of that. Remember, if you're home, that also means that some of that's personal, so you don't want to be too piggish.
Yeah.
So we're able to take that. The home office I love more than anything. That's a personal expense that you're paying money on every day anyway.
How do you value a home office? Just give us a fast example of that. How do you?
Quick example would be, you can do it a couple of ways. I got 5 rooms in my house. They're all almost equivalent. I can do 1/5. Otherwise, what we're going to look is total square footage of the home. We're going to look at the home office. There's total square footage there.
And how do you?
Now, you might have some storage for records. We might be able to add that in. Maybe some room in the garage, whatever it may be. We may be able to boost that up a little bit.
And what's it? I mean, how do you price that? Is it based off the value of the house, the mortgage?
Remember, now in the first example I gave you, it was 1 room over 5, so you're getting 20%. Okay. So at 20%, that means that, let's say I own my home, so I've got mortgage, interest, real estate taxes. I got homeowners insurance. I've got utilities. I've got repairs. I've got exterminator, I got garbage removal, I got security system. All these numbers are tallied up for the whole year, and then what I would get would be 20%.
You got it, man.
On top of that, I'd also take a look at my home. What did I pay for my home? Let's say I paid $500,000 for my home. The land is worth $100,000, say.
Yeah.
Now you can depreciate over 31 and a half years that $400,000 house, and then take 20% of that.
Wow.
So when you add these all up, you're spending this money anyway.
Yeah.
So it's a personal expense that turns around and it becomes a great deduction for any business, not just traders, but any business. And it's not, a lot of people think it's a red flag. It's not a red flag anymore.
Wow. Yeah, unbelievable information you're bringing to the site, Gary. Buddy, I called you. I don't know why I keep on calling you Gary, Buddy. My dad was named Buddy, and I should remember that. Anyway, let me ask you another question here, and
sure.
I appreciate all the time you're giving us. Again, this is for those out listening, tuning in right now. Buddy Hartmann of Hartmann Company. The link's on the site. There's a banner on the site. You just scroll down, you'll see it. You'll see it's actually right on the window right there. You click on it, bookmark that site. It has a lot of great tax information on it, day trader tax information on that site. It says welcome traders. If you trade futures and options for an income, what is the tax rate that you would pay? Does it fluctuate on how much you make, or is it a flat rate? Someone Brian.
I'm going to kind of take that as 2 questions: futures and options.
Yes, it says.
It depends on what the options are on, but let's just say it's straight equity option. That would be taxed at your ordinary rate. For your futures, we were talking about this before, that's going to be a nice blended rate. Futures has the best tax advantage when it comes to being taxed. 60%, if I buy a contract and sell it today, I don't have to wait a year to get long term. That means if I have a gain that's $1,000, $600 of that will be tagged as a long-term capital gain. $400 will be taxed short-term capital gain. So if you were in a higher bracket, say 35% right now, because it's not changing, that blended rate is equivalent to a 12-point reduction. So you would pay taxes on your futures at 23% if you were in the highest bracket. To me, that's beautiful. And that's why we don't do mark-to-market necessarily for profitable futures traders, because you will lose that.
Here's another question, a couple of questions in here. FTCNYC, you want me to ask that question? Thanks. I hope to go back after that, so I can't set up my own business. Can I still elect mark to market? All right. I guess this is a question. Member had cancer, went on disability. He hopes to go back after treatment, so he can't set up his own business. Can he still elect mark to market?
Again, mark to market